Hello again from Core Wealth. Hope you had a good break, those of you who took a break, and all the very best for 2024. We're going to have a look at last year, December, but then the year as a whole, having a look at some of the major events that happened, and then we'll have a look ahead at what we're expecting for 2024. Some of the big news items last year, firstly, was Jerome Powell, the head of the US Federal Reserve, coming out with dovish comments around the future of interest rates. In other words, that interest rates could start coming down. The market reacted really strongly, up nicely in December across the globe. The other side of things, looking at the US equity market, a really strong year last year after having a negative year in 2022. But this was just really attributable to only 7 stocks. So quite a lopsided market that we saw in the US. And then the fact that inflation was coming under control was the next big item, and we could see that happening. The US inflation had been up around as high as over 9% in 2022, now getting closer to 3%. In South Africa, our inflation peaked in the middle of last year at just over 7%, now back to 5.5%. And this evidence saw our bond markets react very strongly as well, both locally and around the world. So let's summarize last year. A lot happened, and what we've got here is a slide that just shows global and local events, and I'll start with the global ones. China changed their policy around COVID. Instead of shutting down whole cities whenever COVID was detected, they actually softened that up a little bit, given the economic impact that was happening. End of first quarter last year, we had the whole banking crisis in the US, which was quite it was relatively narrow, but there was a big concern that it could blow out into the next financial crisis. Silvergate and Silicon Valley Bank were 2 names you may remember. The artificial intelligence hype, there was a lot of that in the first half of last year, and it drove some of those big stocks that I mentioned earlier, the Magnificent Seven, that had exposure to that technology. The US hit their debt limit again, and this is something that happens every number of years. And there was a suspension on their debt ceiling. The US was actually downgraded from a credit rating point of view. Fitch downgraded them from AAA to AA+, still investment grade, but they were downgraded nonetheless. The big talking point from a geopolitical point of view was the Israel-Hamas conflict, which is still going on as we speak, and something that's disrupting things in the Middle East quite a lot. And then during this year, the US 10-year Treasury hit 5% during the day at one stage during this year. And why is that significant? It was the first time that we'd seen interest rates on US debt going that high since 2007. So first time in 16 years that we saw something like that happen. So looking at the big events for our South African investors, we can see it seems a while ago now, but grey listing was something that happened at the beginning of the year. Just controls not being strong enough when measured by the international authorities around unlawful money flows, and that was something that came in, and it has definitely sparked a change in the industry, and a lot happening to tighten up those controls. Lady R, which was a Russian ship that was docked here in Cape Town with some suspicious cargo that no one still knows what was on it. But really created an uproar, and was kind of the last straw on how a lot of global investors saw the South African currency, and we saw the South African currency take a step change in terms of weakening at that point in time. Our inflation peaked at 7.1 in May, and it's now back down within the ranges that it's expected to be of below 6%. The South African Reserve Bank continued to raise interest to protect inflation, and our repo rate peaked at 8.25. Transnet, the South African rail industry, had another shocking year, made big losses during the year, but the knock-on effect of this is that the South African economy is growing at substandard levels. We need to fix things like Transnet, like the electricity supply coming from Eskom. Those will be further positives that will get our economy growing. And then the big thing to end off on, South Africa became the first country to win the World Cup of Rugby for the 4th time, and was a really exciting thing for the South African nation. So how did that translate into markets? This is what happened on the international side of things. Developed market equities or shares globally up strongly for the year, almost 24% for the year. Emerging markets still a strong year, almost 10%, but not as much as developed markets, and that's really been the lag that has come through from China. You'll see Chinese equities there actually down for the year, some 11%. But the big movers for the year, again, US equities, that came through very much at the end of the year. You can see up 5% for the month. But European equities and Japanese equities both up over 20% for the year. A few comments on the South African financial markets over the last year. You can see, first of all, again, a positive December, ending the year off with a fair bit of green, and also the rand strengthening somewhat in the month of December. But over the year, we can see the equity markets up 9.3%, listed property up just over 10%. But most importantly, if we have a look at the 3 and the 5 year numbers, the South African equity market there giving you returns of 13.5% and 11.9% respectively, while you've got inflation hovering between 5 and 6.1% over those periods, which means that you've had real returns ahead of inflation from your biggest portion of your South African equity portfolio, at levels that you'd expect. We'd usually expect returns of somewhere around 7% above inflation. That's what we've seen if you look back over 100 years. And so that's been pleasing to see that improvement happening in the South African equity market. So let's have a look at how our different global US dollar strategies have performed. And from the slide here, you can see that green everywhere. So we consistently have outperformed our competitors from the global defensive strategies, balanced and growth, all of them doing very well. Last year, particularly our global growth strategy outperforming its peers by a very satisfactory margin of 2.5% and giving you almost 15% in dollars return. So something we're very happy with. But if we look since inception, all strategies have outperformed, and the global growth strategy in US dollar terms, some 1.4% ahead of peers, but just over 7% in hard currency has been a very good reward for investors in that strategy. So our other range of global models are these UK denominated global models, so more for investors that think of the world in pounds, but still invested internationally. And you can see since inception some really good outperformance of the peer groups. Although the absolute returns are relatively low because the markets have been weak over that period, these strategies were only started just over 2 years ago now. Over the last 2 years, still outperforming the peer group. The last year, however, hasn't been as good as we would have liked. Some of the emerging market exposure weighed on performance there, and some of the fixed interest exposure to dollars for part of that year also hurt the strategies. But over the longer term, which is what we focus on these things, some good outperformance. So if we have a look for South African investors, how different models have done, much longer term track record, as you probably know. But if we have a look over the last year, we can see our income strategy did particularly well, outperforming money markets by over 3%. So just showing you the benefit of using that rather as a parking vehicle than leaving money on call or even having it in a money market. And then for the year, if we look at our balanced strategies, so Core Wealth Balance, the retirement growth strategy, our recurring income or RI growth strategies, all of them giving you returns of over 13%, so particularly good year for those. And then we can see the 3-year numbers starting to feed through what I mentioned earlier of how South African equity returns had started to be at levels that one expects over the longer term. And so the 3-year number, the 5-year numbers are now at better levels. If you assume a 5% return, our retirement growth strategies over 3 years, some 8% ahead of that. And if we have a look at the balanced and retirement growth over 5 years, now starting to pick up and getting close to double digits. So real returns of getting close to 5%, which is what one looks for long-term retirement savings. And then since inception, all of the strategies ahead of their peers, and so overall quite happy with the outcome over the last year, and the longer term picture looking quite healthy too. So we've looked back, now let's have a look at what we expect for 2024. And this graph just shows you the effects of inflation and how they've started to improve. So the graph on the left just shows, you can see, if we think back to mid 2022, most of those prices and levels were at very, very high levels, and they've improved significantly since then. On the right, we can see the actual inflation indices. Again, those have improved a lot over the last while. And if we look at the bottom one, the Baltic Dry Shipping Index on the right, peaked at very high levels in 2022, and that has improved now, although there has been a bit of a spike recently with the turmoil with in the Middle East. It's still not at those extreme levels that we saw back in 21-22. So the oil price is a big driver of global inflation, and there were concerns after the recent tensions in Israel that that could blow out again. But actually the graph on the left just shows you that that hasn't been the case. Although it spiked initially at the end of last year, the price hasn't continued to go up, and part of that is because the knock-on effect of reduction in oil supply at the moment has been it hasn't affected global oil supply. And in addition to that, the graph on the right just shows you how much more oil is being pumped in the US. So not affected by political tensions, whether in the Middle East or Russia or Ukraine. And so that has dampened the effect on the oil price globally. So a big question in the US is what is their Federal Reserve going to do with interest rates? And this graph just shows you the famous dot plot. Essentially all it means, I'll explain it, is that the Federal Reserve is expecting that they'll cut rates by 0.75% next year. The market, however, is expecting that they'll cut rates even more. And that's what could create some turmoil, but the overall fact that interest rates will be cut next year is a positive for equity markets. So just like you and I, if we don't get a good return on our cash, we look to find a place where we will get a better return. This graph just shows you how much cash has been built up around the world at the moment and how much money is sitting in global money markets. Now at the moment that's been fine because interest rates are high, but as interest rates start to come down, the big question is, where will this money go to get better returns? So one of the expectations is, as interest rates come down, there'll be more money going into equity markets. This graph just shows you, looking back to 1965, having analyzed times when interest rates have started to come down, what has the S&P 500 done? And the orange line just looks at times where there's been a soft landing. In other words, inflation has come under control and the economy has kept growing. And you can see up to a 15% return in the S&P over the following 12 months. On average, during these points where interest rates start to come down, you've seen that there's been an uptick in the S&P of 5%. And when there are periods that the economy's gone into recession, there has been a slight negative return on the S&P 500. So at this stage, we think the picture's tilted towards the equity markets improving as they start to cut interest rates, and hence we would see more exposure to equities in portfolios over the medium term. So 2023 was definitely not a quiet year. A lot happening if you think of those lists of major events during the year, both locally in South Africa and globally around the world. But if you were a global investor in any one of our US strategies, you had returns of between 8 to 15% in hard currency. Even on the UK side, while a bit lower in absolute terms, but returns of between 6 and 8% in sterling. And then locally, the average balance strategy giving you a return of around 13% for the year of 2023. So the message remains the same, in that you want to be exposed to the market. Yes, by the first 10 months of 2023, the South African equity market was negative, but it ended the year up almost 10%. And we can't call the things in the short term, but over the longer term, we're able to position clients' portfolios well and generate outperformance for them. Thanks for watching this. We wish you again a very successful 2024 and look forward to meeting with you during the year.